And joining me here at Post 9 with her fixed income outlook, PIMCO Managing Director and Portfolio Manager Sonali Pier. It's great to have you here. Thank you.
Thanks for having me.
So we do have a little bit of bond market drama to talk about. What is your read on this move, whether it is kind of a warning, a message from the bond market about whatever's happening in the world in terms of the fiscal situation and policy, or is it creating an opportunity, or could it be both?
I think it could be both, right? So I think the bond vigilantes are being quite clear here as we see deficit spending increasing, and all the while we're already above, 100% debt to GDP. So clearly, from a back end perspective, as we think about the 30-year, there are concerns, and we're seeing term premium back in the market. That said, we do prefer the intermediate part of the curve. We think 5 to 10-year offers some value. And as we look at just bonds as a time where we say essentially bonds are back, right? Because these starting level of yields can produce a fair amount of income, and especially as we compare it to the equity volatility we've seen just even year to date, as well as, cash, which can come down if we start to see those cuts that the Fed we're expecting.
It's interesting you mentioned bonds are back, and the long end is you're kind of getting paid to go out there, at least for a long-term portfolio perspective, because we just finished a conversation, it's a familiar one, about, treasuries are no longer creating the kind of diversification that you would like for equities, and therefore maybe you have to go elsewhere to kind of put together an efficient portfolio. Is that not the case?
I think the elsewhere is the question, right? So many are saying, even as we talk about U.S. exceptionalism and the dollar, but where else is a much more difficult answer to give. And I think the reality is that, we are leaning into that curve steepener and highlighting that we think the 30-year still could weaken. All that said, the starting level of yield, not only does it produce a good amount of income, it also can insulate from some level of either rates increasing or credit spreads widening, just because you're starting at a good level, and just the holding time, makes it such that unless you're so precise on when to sell, it's quite difficult.
And can the economy, the real economy, absorb where yields are right now, do you think?
I think the answer is yes, but I think when you come look at the credit markets, you need to be selective, and especially as we go lower in quality. The more economically sensitive areas will be facing the most headwinds from higher rates, and if it lasts longer. Specifically, as we look at the CCC cohort, not only do you see a lot of dispersion, so it's a target-rich environment to be selective in, but it's also one where as interest expense ticks up and interest coverage drops below 1, it does become difficult, and the need to be selective is clear.
Broadly speaking, when you look at things like corporate credit spreads having been pretty tight, I mean, they kind of wobbled a little bit to the upside in early April, but have come back in. Broadly speaking, does that mean that there's not much value there, or can you find it?
Yeah, I think you need to be really disciplined on the approach, right? So, we particularly like right now high quality fixed income, so investment grade, agency mortgages, some areas of securitized mortgage market. As you go lower in quality, picking up that economic sensitivity means you just got to get paid for it, and that's where we got to be more selective, because spreads are tight. Yes, the yield's attractive, and it's part of why we haven't seen significant outflows, even though we did see some through the April volatility. But that income is one where I think many investors are kind of flirting with problems potentially down the line.
You mentioned you do still expect the Fed to be cutting. I mean, I guess in theory that should maybe anchor rates across the curve a little bit from here. How much cutting, kind of when, what are they going to be reacting to? Yeah,
and so, the Fed clearly shifted to that data dependence at the right time. It would be a really difficult environment to give forward guidance in. And so while we have seen soft indicators show weakness, we haven't seen the hard data really show that yet. And yes, the hard data does tend to lag, but I think the Fed was going to wait through the summer, right, between the 90 days pause actually going into effect, and then with the tariffs, and then kind of seeing a month or two of data. So likely we think the September meeting is when the Fed is likely to cut, and probably we'll see a couple cuts.
Bigger picture, I mean, you mentioned the bond vigilantes seem active again, and when we look at yields at the level they're at relative to the government's fiscal position and the projections, how do we jive that with the fact that in the late 90s or 2000, we had a nominal surplus at the federal level, and we were at 5.5% on the 10s, right? In other words, it doesn't necessarily tie to a particular yield level. Now, 5.5 was coming down from 7, and it seemed low at the time. But why is it, I guess, alarming if it is when yields get up from where they are right now?
I think also many in the market haven't seen that for so long.
Yeah.
So, you had to go back a few decades to share that.
Not everyone's as old as I am. You're right.
Well,
yes.
I mean, I just more mean that the recency bias
exactly.
that's in the market. And if we think about even some of the super secular themes, around U.S. exceptionalism, around the U.S. currency itself, right? I mean, we could have a scenario where it continues to depreciate, but it doesn't challenge the reserve status of the dollar. Mm-hmm. We just had our secular forum, and these were many of the topics we discussed. That and part of why we still think that the steepener makes sense, even though we have steepened, we continue to think that 30-year is vulnerable. Although we really do like fixed income overall.
I guess the other answer is that the 5.5 back then was on a base of much lower debt, and it could easily be serviced as opposed to where we are right now. Sonali, it's great to catch up with you. Thanks so much.